Well, the yucky bond market actually will play in the bank's favor. Higher rates from a bad auction, will help the banks, and the banks have correlated, unfortunately, from a trading perspective, with what's gone on, with the 10-year yield. The reality is the banks delivered. The earnings were good enough. They were both crowded trades. You could poke holes in both companies and say this and that, but at the end of the day, they're generating capital, generating book value. There's no loan growth right now because there's so much money, liquidity flooding the markets, which means excellent credit quality. A very strong economy will eventually lead to loan demand. And loan demand and higher interest rates will lead to earnings that are estimates that are far too low for next year. So I expect estimates to rise as the year progresses. I expect loan growth to show up. And I also expect that trading and investment banking will continue to be very good places to be. The backlogs for investment banking are spectacular.
What's going to happen with deposits, though? As we were writing about this week, they have these competitors in the crypto world that are offering 4% yields, and that's conservative.
Well, not an issue today at all. Most banks are incredibly flush with cash, far too much cash. If you look at banks year to date, double-digit growth in deposits and loan growth pretty flat. So, no competition at this point. Eventually, that may well matter, but core deposits is what banks have, and those are cheap deposits versus the other more wholesale type borrowers. In a rising rate environment, they may face some issues trying to gather those deposits. And I continue to believe that fintech and banking have to partner up. I don't see them as necessarily competitors. I see them as partners as time goes on.
Fair enough. But again, just thinking through what's going on in sort of the very short term space where with T-bill yields trying so hard to be deeply negative, where all of this money, as you said, is being parked at the Fed for about 5 basis points return. Where does that go from here? I mean, what normalizes things? Only if interest rates kind of drag things higher? Because if we're talking now about, a Fed rate hike in the picture by the end of next year, as a lot of the market is after the numbers this morning, does that resolve this liquidity situation?
It helps. I think that one of the best things that solves the liquidity situation is a continued strong economy where people go out and actually spend the money. And we really need to see manufacturing go out and build new plants and hire people and spend money and start to borrow money. And I think that, again, the stimulus programs have been fabulous, but they've created a lot of deposits at the banks and a lack of loan demand. As the deposits get run down and loan demand happens, earnings go up. And I think that's really great for the economy. And I think the banks will actually be laggards in increasing the cost of their deposits. They're still lowering them as we speak.
Well, we should leave it there, Anton, but I just want to check in with you for investors who are looking at whether they should buy some of the big banks on this weakness or if you'd stick with some of the regionals that you've long recommended. Where should people put their money to work in this space?
Well, I kind of like a little bit of a barbell approach. I like the self-help story, so I like Wells Fargo at this point in time. At some point they get out from underneath the Fed orders. It's still relatively cheap to forward earnings, and I think estimates can go up if they can grow their balance sheet. And then on the smaller banks, I like companies like First Horizon and Live Oak Bank. Live Oak's a mix between a fintech and a bank, and they also have a venture fund that invests in fintech. So I think there's a lot of value embedded in that portfolio.
Shepard Smith here. Thanks for watching CNBC on YouTube.